America's economy is sending mixed signals right now, and that is exactly what is making investors, households, and US Federal Reserve so uneasy. Growth and productivity look solid, but the job market and the bottom half of the country are showing clear signs of strain, prompting louder warnings that a recession could be coming. On the surface, the headline numbers still look reasonably strong. Output is expanding at a decent pace, and worker productivity remains elevated, helped by a wave of corporate spending on artificial intelligence and software. In prices, the latest delayed consumer price index for September showed inflation running at about 3% year-on-year, with prices up 0.3% over the month, slightly softer than many economists had feared, but still above Fed's 2% target. Stock markets, which recently tanked but now are back up again on hopes that AI-driven profit and lower interest rates will continue even as many customers report feeling squeezed. Consumer spending, however, is clearly losing some momentum. The catch-up retail sales data show that US retail and restaurant sales rose just 0.2% in September from August, down from the 0.6% monthly gains seen earlier in summer. Adjusted measures that strip out volatile categories are even softer, with one key control group metric actually slipped slightly, a sign that low and middle income households are running out of steam after months of front-loaded spending. Industry trackers describe overall retail revenue as roughly flat compared with a year ago, with unit volumes falling as shoppers trade down, hunt for discounts, and focus on essentials. The latest jobs report added another layer of complexity. The long-delayed September employment data showed that US added 119,000 jobs, more than forecasters had expected, but still modest compared with earlier in the recovery phase. The unemployment rate nudged up to 4.4%, the highest in about 4 years, and earlier months were revised to show that the economy actually lost jobs in August instead of gaining them. Fed officials have called this gap between solid GDP growth and lower job creation a conflict that cannot last, and it's forcing them to weigh decent top-line growth against a gradually weakening labor market. This is why the picture feels confusing. It looks like a jobless boom. A strong AI-fueled economy under normal circumstances should be creating plenty of new jobs, especially now that the Fed has already cut interest rates twice this year. Instead, companies are pouring in money into new technology and software while staying cautious on hiring, partly because they are unsure about how President Trump's shift on trade and immigration will affect their costs and access to workers. The federal shutdown has also made that uncertainty worse by delaying inflation and jobs data, leaving policymakers to make big decisions using statistics that were weeks out of date. The December Fed meeting now sits right in the middle of this fog. Futures markets tracked by tools such as CME Fed Watch still place in high probability of another 25 basis point rate cut in December, helped by slightly softer than expected 3% inflation print and only modest September retail and job gains. Key voices like New York Fed President John Williams and San Francisco Fed's Mary Daly have signaled that they are open to cutting interest rates again if the data shows labor market cooling further without a renewed burst of inflation. But Dallas Fed President Lori Logan and other hawks have warned that after 2 rate cuts already this year, they would need clear evidence of faster than expected disinflation or sharper job weakness before moving again, and they note that inflation is still stuck at around 3%. Outside the Fed, a growing number of analysts are sounding recession alarms, and much of that concern centers on America's K-shaped economy. Wealthier households and asset owners at the top of the K are still spending and benefiting from strong markets, while the bottom half is being squeezed by high prices, lower wage gains, and rising borrowing costs. Rising delinquencies, flat or falling unit sales, and softer hiring in cylindrical sectors are cited as early signs that a downturn is already forming at the lower end, even while the national GDP looks fine. Economists warn that a prolonged AI-driven jobless expansion like this leaves the US unusually vulnerable if productivity fades, if markets correct, or if Fed misjudges its December move. The lack of a strong labor market buffer could tip the economy quickly from confusion into recession. What do you think about this? Let us know in the comments, and like, share and subscribe to ET Now for more such news and views.
If you like this video, then like, share and subscribe to ET Now.